Hello, my name is Kevin Lemaire, and this is my investment project. So, apparently my uncle has left me an inheritance of $50,000, but he does not want me to spend it for 10 years. Instead, he would like me to find some kind of investment opportunity. So, I have found four choices to go with. The first is a stock option, and I found a stock with 10-year history of growth. And the next option is a 10-year CD, to purchase a 10-year CD at the best interest rate that I could find. The next option is to buy a rental property that I have found a decent one for $210,000. And the final one is peer-to-peer lending. Here we have the option to purchase stocks with the Microsoft Corporation, NASDAQ MSFT. The initial closing price in 2013 was $26.83, and the doubling price was $53.66, and the doubling price was met roughly between 2017 2018. So it's been 1 year to double prices. That's roughly what it'll take. And as we look down here, it's a nice chunk of change after 10 years, 51 mil, 200,000. And we have advantages to it. There's potential high returns, as we've seen, that can go well. That's always an attractive thing. And direct ownership, you can have individual ownership of stocks, and it'll provide you with a direct stake in the company. However, the disadvantages are higher risks. If this company does poorly, or if they start losing things, then your worth goes down with it. Also, if you just decide to invest in one single stock, you are lacking in diversification. You need to get a broader portfolio and try to put some eggs in some other baskets. There's also the market volatility, which we have been seeing a bit of. Next, we have the 10-year CDs option with Apple Federal Credit Union at 4% APY. So, as we look over here at our chart, it's a conservative choice because, as we can see, it is a steady increase in value as it goes up over 10 years. There's very little that's needed to be worried about. We look down here. It's a nice conservative increase in returns. That's part of the advantages that you have if you go with a 10-year CD. You have some predictable returns. You also have the lower risk that's involved because it is such a conservative investment, and there's the stability and the security. The disadvantages is the interest rate risk. If you lock at a lower interest rate, then you're going to be stuck with that interest rate. There's also the risk of inflation and your opportunity costs. Next, we have the rental properties. Now, this is not doing us very well because, as we can see, we're taking loss after loss after loss after loss. We had to do 20% down and finance the remaining on this rental property. So we had 210,000 and the 20%, which left us with about $42,000. So we got 50,000, so we'll be able to pay that down payment for that, which leaves us with about $8,000. And as we're moving down, we check out the monthly payment that we can potentially expect to receive, which is $1,088. The 1 year income from that is $18,000. However, our net cash flow is going to be negative $8,115.92. Now we're coming up with that total because we have all of our annual costs here between the mortgage, property tax, home insurance, repairs, property management, the potential for vacancies, the water and trash bill. We have $26,115. It's costing us every year just to rent out this property. And we can see the net cash flow over 10 years. We're taking a loss of almost $100,000, $81,000 over 10 years. So the advantages to getting a rental property is obviously the potential income, the potential rental income that you can receive from having tenants, depending on how many you have, how much you want to charge. You have the appreciation also of the value of the property over time. Here recently, over the past few years, we saw a boom in the market where housing prices were going exponentially up. My house, for instance, almost doubled in value because of market value. However, the trends are starting to change, and that those values are starting to take a dip back down. So that's part of the disadvantages, is that you have that market risk. You have that risk of the fluctuation of the market and how trends will go within real estate markets and real estate trends. And you have the potential for liability and legal issues as well. If you're a landlord, you have to worry about people getting hurt on your property, or having to deal with different types of legal issues. I mean, if you got to evict somebody, or if you got to deal with, so all kinds of stuff can come up. So the last one that we have here is the peer-to-peer lending. Now, peer-to-peer lending is when it's basically what it says. You are loaning out some of your money to other independent borrowers. So according to Forbes.com, the average interest rate for peer-to-peer lending is anywhere from 7 to 36%. So we dropped it in at 15%. So with our compounding and the 50,000, we get, after 10 years, we could potentially make $222,000. So we go down here, we can see how we will grow over time. Now there's advantages such as the diversification of your portfolio with peer-to-peer lending. If you are coupled up with some of the other choices that we had, such as the stocks and rental property, peer-to-peer lending might be a good thing to add, just so you have extra cash flow in there. And you can get fairly good returns if you have good borrowers who don't default on their loans and who will follow through and pay you on time. You also have a lot of control over what you're investing. However, you got the default risk of people not paying that money back, and then you being left high and dry, and you got the lack of liquidity in there as well. So if I was going to go with my choice out of all of these, I am going to go with the rental property. Now, the reason I say that is, even though we saw there were great losses taken on this rental property, this was just the information that we were given for this project. In reality, there's not an investor that personally I have ever had experience with that would say that real estate is a bad investment. It's just what type of real estate is best for you. You have to make sure that you're making good choices and you're well educated and you know exactly what you're getting into. And it has to meet your lifestyle. It's just like anything else. You can't live beyond your means. You can't own real estate beyond your means. As long as you're making the right choices for your lifestyle and you're not going over what you can handle in terms of property management, in terms of monetary situations, and in terms of time management, really, because there's a lot of time that goes into this, especially if you're not trying to dole out some of that extra money to property managers. So it's a great opportunity as well for ADUs. This is a growing trend where if you have extra property in the back, or extended property attached to your building, your house, you could put a attached dormitory unit there where you can pull extra cash flow out of that as a whole rental place. You could put 2 unit to 4 unit rental units on a single property next to your house, and you can maximize the quality of or maximize, excuse me, the value of your property off of just one purchase potentially. So even though this model presented me with a poor option, I would still go with the rental property as an investment. So thank you for your time, and I hope you have a great week. My name is Kevin Lemaire, and this has been my investment project.